price action is often overcomplicated and even confusing for many traders. Well, Heikin Ashi candles simplify everything. Pay attention because this will be your ultimate price action guide using Heikin Ashi candles. So Heikin Ashi candles offer a unique way to view price action, helping you spot trends and remove a lot of the market noise. They differ quite a lot from traditional candlesticks. Traditional candlesticks show the open, high, low, and close prices for a given time period. Heikin Ashi candles, on the other hand, use a different calculation method. This method smooths out price information, making trends easier to spot. The main difference lies in how Heikin Ashi candles are calculated. Heikin Ashi uses averages. This averaging process creates a smoother price chart, filtering out some of the noise that can make traditional charts harder to read. These candles have unique colors and shapes that tell you about market trends. In an uptrend, Heikin Ashi candles often appear as a series of green candles with small or no lower wicks. In a downtrend, you'll see a series of red candles with small or no upper wicks. The color of a Heikin Ashi candle tells you about the overall direction of price movement. A green candle implies upward movement, while a red one indicates downward movement. The size of the candle body shows the strength of the move. A large body means a strong move, while a small body implies a weaker move. Heikin Ashi candles also have wicks, just like traditional candlesticks. These wicks can give you clues about potential trend changes. A long, lower wick on a red candle might imply that buyers are starting to enter the market, potentially signaling a trend reversal. In a strong uptrend, you might see a long series of green candles with little to no lower wicks. This pattern is much clearer on a Heikin Ashi chart than on a traditional candlestick chart. Heikin Ashi candles can help you stay in trends longer because they filter out some of the minor price fluctuations that might shake you out of a trade too early. When using these candles, you might notice that trends appear to last longer and reversals seem less frequent compared to traditional candlestick charts. Now, Heikin Ashi candles aren't perfect. Because they use averaged prices, they can sometimes lag behind real-time price movements. This means that while they are great for finding trends, they might not be the best tool for pinpointing exact entry and exit points for trades. One key difference between Heikin Ashi and traditional candlesticks is how they handle gaps. Because Heikin Ashi uses averaged values, it doesn't show gaps between trading sessions. This can be both an advantage and a disadvantage, depending on your trading style. If you're trading a market where gaps are important, like stocks or forex, you might want to use Heikin Ashi in combination with traditional candlestick charts. When reading Heikin Ashi candles, you need to pay close attention to several key aspects. First, you look at the candle color. In Heikin Ashi charts, green candles typically represent bullish movement, while red candles indicate bearish movement. The color of the candle tells you about the overall direction of price movement during that period. A green candle means the closing price was higher than the opening price, so this means buying pressure. A red candle shows that the closing price was lower than the opening price, indicating selling pressure. Next, you pay attention to the size of the candle body. Larger bodies indicate stronger moves in the market. A candle with a large body shows that there was a significant price movement during that period. In an uptrend, a large green candle implies strong buying pressure. In a downtrend, a large red candle indicates strong selling pressure. The size of the body compared to previous candles can also give you clues about the strength of the current trend. If you see a series of candles with progressively larger bodies of the same color, it often indicates a strengthening trend. This means increased momentum. You can also easily find instances of loss of momentum, like in this example, where the market was in a downtrend and the candlestick started to become smaller and more uneven. This is the first sign that the downtrend is losing strength and a trend change is coming. The presence or absence of wicks on Heikin Ashi candles is another factor to consider. Wicks can tell you a lot about the price action during that period. Long wicks, on the other hand, can indicate potential reversals or indecision in the market. A long upper wick on a red candle or a long lower wick on a green candle might show that the current trend is losing steam and a reversal could be coming. Large wicks can indicate a high level of volatility or uncertainty in the market. If the high and low prices for a particular time frame are significantly different from the open and close prices, it may indicate that there was a lot of buying and selling activity during that period. This could be a sign that the market is indecisive or that there is a lack of clear direction. On the other hand, if the wicks are small or absent, it may indicate that the market is more stable. Consecutive candlesticks with long wicks on a Heikin Ashi chart is something you should pay attention to, because this can potentially indicate a change in trend. When these wicks overlap, they create a price zone that is likely to exhibit buying or selling pressure. Changes in the candle color are also important to watch for. A shift from a series of one color to another might signal a potential trend change. For example, if you've been seeing a long series of green candles and suddenly a big red candle appears, it could be an early warning sign of a trend reversal. However, with Heikin Ashi candles, trend changes often appear more gradually than with traditional candlesticks. You might see a few small-bodied candles of the opposite color before a full reversal takes place. This can actually be an advantage, as it can help you avoid getting shaken out of trades by minor price fluctuations. Heikin Ashi candles make market structure easier to read. In an uptrend, these candles have no lower shadows when the trend is strong. This means the low of each candle is the same as its open. You see a row of green candles with only upper shadows. This pattern tells you buyers are in control. As the uptrend goes on, each green candle's high is usually higher than the last. This creates higher highs. At the same time, each candle opens higher. This forms higher lows. These higher highs and higher lows are the building blocks of an uptrend. When the uptrend starts to weaken, you might see small lower shadows on the green candles. This is a hint that sellers are starting to push back. It's not time to sell yet, but it's time to pay attention. In a downtrend, things flip. You see red candles with lower shadows, but no upper shadows. This shows a strong downtrend. Each red candle's low is lower than the last, making lower lows. The highs are also dropping, forming lower highs. Sometimes the market takes a break from trending. This is called consolidation. With Heikin Ashi candles, you'll see a mix of red and green candles. Often these candles have both upper and lower shadows. The highs and lows stay about the same, making a range. Heikin Ashi candles can help you spot when a trend might change. If you've seen lots of green candles in an uptrend, and suddenly there's a red candle with no upper shadow, the trend might be about to reverse. When looking at market structure with Heikin Ashi candles, watch the size of the candles too. In a strong trend, the candles tend to be bigger. This shows price is moving more in the trend's direction. If the candles start getting smaller, the trend might be losing steam. Also, look at how many candles of the same color appear in a row. A long string of green candles shows a strong uptrend. A long string of red candles shows a strong downtrend. When you start seeing more switches between red and green, the trend might be weakening or changing. Heikin Ashi candles can help you find support and resistance levels too. In an uptrend, Old broken highs tend to act as support. In a downtrend, old broken lows often act as resistance. These levels are key parts of market structure. The sequence of price swings is also important. A swing high happens when price reaches a peak and starts to fall. A swing low is when price hits a low point and starts to rise. These swings show where buyers and sellers are fighting for control. In an uptrend, you'll see swing lows getting higher over time. Each new low is higher than the last. Buyers are getting stronger. At the same time, swing highs are also rising. Each new high is higher than the one before. In a downtrend, it's the opposite. Swing highs get lower over time. Each new high is lower than the last. Sellers are in control. Swing lows also keep getting lower. Sometimes, swing highs or lows bunch up at the same level. We call this equal highs or equal lows. They're important because they show areas where price had trouble moving past before. Watching how these swings form and change can tell you a lot about market strength. If swings are getting bigger, it might mean the trend is gaining power. If they're getting smaller, the trend might be losing steam. Speed matters too. Sharp swings often mean more power behind the move. Slow, gradual swings might mean the trend is weaker. Heikin Ashi candles can help spot major support and resistance levels through color changes and wick patterns. When candles change their color and form wicks, it often happens at support or resistance. With Heikin Ashi, you might see red candles turn green at support. This shows buyers stepping in. So price is falling with red candles. Then, at a past price level, the candles turn green. You might also see green candles turn red at resistance. This shows sellers taking control. For instance, price is rising with green candles. Then at a past resistance, the candles turn red. A long lower wick on a green candle at support shows strong buying. A long upper wick on a red candle at resistance shows strong selling. For example, price approaches this support level. You see a red Heikin Ashi candle with a long lower wick. The next candle is green. This pattern implies support was held. The long wick shows buyers stepped in at the low. At resistance, you might see a green candle with a long upper wick followed by a red candle. This pattern implies resistance held. The long wick shows sellers came in at the high. Sometimes, you'll see a spinning top Heikin Ashi candle at a major level. This is a candle with a small body and long wicks on both sides. It shows indecision. If this appears at a key level, it could signal a turning point. The size of candles matters too. Big candles show strong moves. If you see big green candles with small wicks breaking above resistance, it implies a strong breakout. The same goes for big red candles breaking below support. Heikin Ashi candles can also help you spot false breakouts. You might see a candle break past support or resistance, but with a long wick pointing back into the range. This could be a fake out. In this case, you wait for more candles to confirm the break. Now, support and resistance aren't exact prices. They're more like zones. You might see Heikin Ashi candles change color near a level, not exactly at it. The wicks might not touch the exact level, while the bodies stay a bit away. This is normal. Also, strong support or resistance often gets tested more than once. You might see Heikin Ashi candles change color at the same price several times. You might also see long wicks repeatedly touch the same level. This repeated pattern can make a level weaker with each test of the level. Sometimes, support and resistance switch roles. Old support can become new resistance, and vice versa. Again, watch for Heikin Ashi color changes and wick patterns at these flipped levels. They can signal if the level is holding in its new role. Time frames matter when using these candles to spot key levels. Higher time frames often show more important levels. A color change with a long wick on a higher chart might be more significant. Supply and demand trading becomes a lot easier using Heikin Ashi candles. These candles will help you spot key areas where buyers and sellers clash. The supply and demand zones are like the spots where one team suddenly gains the upper hand. For long trades, you're looking for places where buyers, meaning demand, overpower sellers. For short trades, it's the opposite. You're looking for areas where sellers take control. You're searching for big, bold Heikin Ashi candles that really stand out. These big candles are like flashing neon signs, telling you something important happened there. But you don't just want the big candles themselves. You want to find where they started, their origin point. This is where the real action begins. Once you spot this origin, you'll mark a zone around it. This is your supply or demand zone, depending on whether price moved up or down from there. Now, Heikin Ashi candles are a bit tricky because they start from the middle of the previous candle. So you need a special way to mark these zones. For a supply zone, where sellers might take control, look for the last green, bullish Heikin Ashi candle before a big drop in price. Then draw a box from there up to the highest point, just before the drop. For a demand zone, where buyers might step in, find the last red, bearish candle before a big move up. Draw your box from there, down to the lowest point just before the price jumped up. These zones come in different flavors. First we have fresh zones. They haven't been touched yet. Price hasn't come back to test them. Then we have non-fresh zones. Price has visited them once. And finally, we have used up zones. Price has bounced off them several times. They're not great for big trades, but might work for quick in and out moves. When you're marking these zones, use a simple approach. Don't clutter your chart with too many zones. Keep it clean and focus on the most important areas. Try to have no more than 3 to 5 zones on your chart at a time. Here's what makes a Heikin Ashi zone worth your attention. First, the fresher the zone, the better. Traders are more likely to still have orders waiting in a zone that hasn't been tested yet. Also, strength matters. Look for zones where price left in a hurry. These strong moves show a big imbalance between buyers and sellers. Then focus on zones near the current price. Don't try to plot every zone since the beginning of time. And finally, look for dense zones. Zones where price hung around for a while before making a big move are often powerful. It's like pressure building up before an explosion. Now let's talk about how to spot the best Heikin Ashi supply and demand zones. First, check out how price left the zone. Did it shoot out fast, or did it slowly drift away? The faster and stronger the move, the more likely it is that some big players placed heavy orders there. Next, look at how long price hung around in the zone. The less time it spent there, the more explosive the imbalance between buyers and sellers. Also, pay attention to how far price traveled after leaving the zone. The further it went before coming back, the juicier the potential trade. And again, don't forget about freshness. The first time price comes back to a zone is usually the strongest opportunity. Each visit after that weakens the zone a bit. So how do you actually trade these zones? It's pretty straightforward. For buying, wait for price to touch a demand zone and bounce up with a green Heikin Ashi candle. Ideally, this candle won't have a lower wick, showing strong buying pressure. For selling, look for price to hit a supply zone and bounce down with a red Heikin Ashi candle. A candle with no upper wick is better, indicating strong selling pressure. Place your stop loss just below the demand zone for buy trades, or just above the supply zone for sell trades. As for when to close your trade, Hold it until price reaches the opposite type of zone. So if you bought at a demand zone, you'd aim to sell when price hits the next supply zone up. Another option is to close part of your trade when you see the candles change color, signaling a potential shift in momentum. Many traders ignore Heikin Ashi charts because they are unable to backtest these candles in TradingView. I have a solution for this. This is how I backtest price action using Heikin Ashi. First, open up TradingView and look for the chart type selector. It's usually set to candlesticks by default. Click on it and change it to line. This will turn your chart into a simple line. Then you need that line to blend in with your background. So you need to set the line color the same with your background. Next, you need to add the smoothed Heikin Ashi indicator. You look for the indicators button and you add it to your chart. Once the indicator is on your chart, you'll need to adjust its settings. Find the two length parameters and set both of these to 1. This will give you the most basic, unsmoothed version of Heikin Ashi candles. And there you have it. Now you can step back and backtest. You should see Heikin Ashi candles overlaid on your nearly invisible price line. Volume leads price. Often, you'll see volume increase before a big price move. With Heikin Ashi, these moves are easier to spot and trade. Think of volume as the fuel that drives price. More volume means more traders are active. So this is how to use Heikin Ashi with volume. First, look for trends. Heikin Ashi candles of the same color show a trend. If you see many green candles in a row, it's likely an uptrend. Now check the volume. Is it rising as the trend continues? That's a good sign. It means more traders are joining the move. Then watch for reversals. Heikin Ashi candles change color at turning points. If you see a red candle after many green ones, it might be a reversal. But don't jump in yet. Check the volume. A spike in volume on that red candle adds weight to the reversal signal. Also, use volume to confirm breakouts. Heikin Ashi candles might show a price breaking above resistance or below support. A surge in volume at the breakout point makes it more valid. Look for quiet periods. Sometimes, Heikin Ashi candles get small. Volume often drops too. This can mean a big move is coming. You can also spot accumulation and distribution. In accumulation, smart money buys quietly. You might see Heikin Ashi candles staying in a range. Volume might be low or steady. This could mean big players are slowly buying. Distribution is the opposite. Smart money sells to the crowd. You might see Heikin Ashi candles making new highs, but volume isn't growing. This could mean big players are selling to eager buyers. Very important, don't just look at one candle. Watch how they form over time. A single high volume candle might not mean much, but a series of them is more powerful. Also, pay attention to where volume spikes happen. Are they at support or resistance levels? This can be very telling. High volume at these points often signals important moves. Here's another way to use this method. Look for divergences. That's when price and volume don't match up. For example, candles might make new highs, but volume is dropping. This can warn you that the move might not last. These candles are great for showing momentum. When they're all one color, the trend is strong. But watch out for candles with long wicks. These can signal a possible reversal, especially if volume is high. You can also use moving averages with these candles. When price crosses a moving average with high volume, it's often a strong signal. And don't forget about supply and demand areas. When price approaches a key area, watch the volume. A rejection with high volume is a strong signal. Moving averages and Heikin Ashi candles work well together. First, you see the trend from moving averages. Then, You evaluate the momentum from Heikin Ashi, and together will help you make better trades. Here's how it works. First, let's talk about trend direction. Moving averages show you if the market is going up, down, or sideways. When price stays above a moving average, it's likely an uptrend. If it's below, it's probably a downtrend. Heikin Ashi candles make trends even clearer. In an uptrend, they'll have little or no lower shadows. In a downtrend, they'll have little or no upper shadows. Then we have trend strength. The space between price and the moving average tells you how strong the trend is. A big gap means a strong trend. Heikin Ashi candles help here too. Long bodies show a strong trend. Short bodies or dojis, when open and close are very close, show a weak trend. Moving averages can signal when a trend might be changing. If price crosses a moving average, it could mean the trend is shifting. Heikin Ashi candles give extra clues. If you see a candle with both upper and lower shadows after a strong trend, it might mean the trend is weakening. Moving averages often act as support in uptrends and resistance in downtrends. Price might bounce off these levels. Heikin Ashi candles can show you how price reacts at these levels. A long-bodied candle bouncing off a moving average is a strong signal. When price gets too far from a moving average, the market might be overbought or oversold. It could snap back soon. Heikin Ashi candles can confirm this. If you see dojis or candles with shadows on both sides, far from the moving average, a reversal might be coming. The angle of the moving average tells you how fast the trend is moving. A steep angle means a fast trend. A flat angle means a slow trend. Heikin Ashi candles add to this. Long candles in the trend direction show a fast trend. Short candles or dojis show a slow trend. When price hugs a flat moving average, the market is probably ranging. It's not trending up or down. Heikin Ashi candles in a ranging market will have shadows on both sides. They'll be smaller than in trending markets. Sometimes price might briefly cross a moving average, but not start a new trend. This is called a whipsaw. Heikin Ashi candles can help avoid these false signals. If the candles don't show a clear trend change after crossing the moving average, it might be a false signal. In strong trends, price often pulls back to the moving average before continuing. This can be a good entry point. Heikin Ashi candles during pullbacks often have shadows against the main trend. When they start showing strong trend candles again, it might be time to enter. The distance between fast and slow moving averages can show market volatility. A big gap means high volatility. Heikin Ashi candles show volatility too. Big candles with long shadows mean high volatility. Small candles with short shadows mean low volatility. When price gets too far from a long-term moving average, the trend might be near its end. It's stretched too far. Heikin Ashi candles can show exhaustion too. If you see smaller bodies or dojis after a long trend of big candles, the trend might be tiring. The strongest signals come when multiple factors line up. Maybe price is at a key moving average, and Heikin Ashi candles are showing a strong trend resume. That's a stronger signal. Now, if you're ready for more interesting trading guides, go ahead and watch one of these videos.